Hi there, welcome once again to the Dukascopy TV studio. I'm Ben Jones. Alongside me for another market update is Patrizio Merciai from Gonet Cie. Patrizio, once again, it's a pleasure having you in the studio.
My pleasure, thank you.
So let's begin by looking at the US. Can you compare for us the recent retail sales data and the industrial production data? What do these two figures mean for the economy?
Oh my, they mean a lot, but you know, I mean, let me start this way. Markets or investors have been really looking for weaker data. You know, they don't believe the growth stories, and they tend to focus on every piece of data which happens to be, you know, a bit weaker. And we had a bit of a softer tone to retail sales in the US. But mind you, we are still talking about 3.6, 3.7% growth rate, which is not weak by any standards. But well, it has been a bit, you can see it on the chart, that's a blue line. You can see this kind of a bit of a slowdown, very small. What's interesting is that about the same time, we had a positive surprise on industrial production, where you have a firmer tone, and it was an upside surprise. So, I mean, you will always have this kind of, you know, balance between, or mix between some weaker, some stronger indicators. But I think really the point is that, for instance, industrial production, the strength was broad-based. And it means that there's a lot of confidence in the whole of manufacturing, in construction as well, in a lot of businesses. So I think really, I mean, you can still have surprises down the road, but I think growth in the US is on a strong footing. It's a decent 3% more or less growth. And I think that's a very good backdrop to the world financial markets.
Okay, now last time you were in the studio, you outlined that the Fed were keeping a close eye on voluntary job leavers. Now it seems that the job openings rate compared to the hire rate is something that they're looking at. Can you explain the significance of this for us?
Oh my God, so technical. Your questions are so technical, I don't know. But you know, you're right. I mean, it's jobs, jobs, jobs. Everything revolves around it. You know, the Fed will be meeting at Jackson Hole, and the topic will be the labor market. So really, the whole question is when the Fed will start hiking interest rates. And all depends on how much slack there is still in the labor market. So Janet Yellen uses a lot of indicators. She probably has, I've never seen it, but I suppose she has a big dashboard with lots of indicators. And there is one which has been flashing a positive signal for the economy, but it also means that it cuts down a bit of room of maneuver for the Fed. This is the job openings rate. It's an important indicator. It's not very popular, but it's very important because it means that 3.3% of all jobs in the US economy are actually new, just opened. And this is a rate of progress which is above the top of the last cycle. So it's a record high, so to speak. It means that companies, businesses, big and small, are creating jobs, are opening new jobs to a faster pace than ever. And actually, you have other data in this survey which shows, for instance, 1 out of 4 jobs is difficult to fill, i.e. businesses are not finding anymore the appropriate people to find jobs. So it's a measure, let's say, of slack disappearing in the labor market, and that's probably one of the indicators that the Fed is watching very closely now.
Okay, so to what extent is the information that we've already discussed, how is it going to influence the Fed's decision on interest rates?
Okay, so you see, we know the roadmap for the Fed. We don't know all the steps, but they are almost done with tapering. So it means that asset purchases, bond purchases will come down to 0 in 6 weeks now. And then they will pause. They will pause for some time. Now the question is, when will the pause end and when will they start hiking, actually raising interest rates? And let's say the market consensus is more or less for the 3rd quarter of next year. I would say that with the type of data, the kind of data that we are getting now, that time might be shorter. That rates would start coming up in the US on the dollar sooner than the market currently is expecting. I would say maybe not by many months, but probably it will be in the second quarter, so 3 months, 3-4 months ahead of what the market is expecting. So obviously this has an impact on the dollar outlook, this has an impact on the pricing of bond markets and everything. We probably need confirmation, but I would suspect that the market consensus will probably adjust to earlier rate hike in the US.
Fantastic. And then finally, if we can just look at Europe as well. Obviously, Germany is the key driver for the Eurozone, but recently the surveys, the IFO and the ZEW economic surveys, they've indicated somewhat of a downtrend. Now, can you explain the reasons for this and what effect will this have?
Oh, you're a keen watcher of economic data. And it's true. I mean, we all know that Europe, especially the Eurozone, has a much weaker economy right now than the US. All the data that came out were not really a surprise, but there was one, as you mentioned, which was a bit of a letdown, a disappointment, which was as you say, the surveys, the confidence surveys in Germany. That have been weaker than expected, especially the ZEW. And obviously one of the most quick explanations is probably the impact of sanctions against Russia and the backlash, the boomerang effect of those sanctions on the German economy. I would not say that will be a staying factor. First of all, we don't know how long the crisis will last. And second, I would say that probably businesses are reacting to uncertainty. It's more uncertainty, it's more this factor rather than really the real impact, because after all, Russia is just one of the exports market of Germany, and the German domestic economy is okay right now. So I would not say that sanctions will have a deep impact, but uncertainty is certainly a factor. Something also you can bear in mind is that the ZEW has a very important financial component. Most of the people surveyed are from the financial industry, so probably they have a shorter term reaction, a quicker reaction than, let's say, manufacturing. So I would say, okay, it's a disappointment. It's something we will have to continue watching, but I would not say that it would derail, let's say, the growth of the German economy.
Fantastic. Patrizio, once again, thank you very much for joining us.
My pleasure. Thank you.
And thank you for watching. Do make sure you keep clicking back to Dukascopy TV, as we'll be bringing you plenty more updates and exclusive interviews. Bye for now.